Hello virtuous investors, this is an effort in helping you achieve financial freedom through virtuous investing. Wealth creation large extent depends on behavioral finance. It combines elements of psychology and finance to explain how human biases and emotions can influence investment choices. Our research has shown that investors often make irrational decisions due to factors such as overconfidence, fear, and herd mentality, which can lead to suboptimal investment outcomes. Understanding these behavioral heuristic biases and controlling them is crucial for successful investing. Let us understand what is heuristics. Heuristics are mental shortcuts or rules of thumb that individuals use to simplify decision-making processes. Heuristics can lead to biased judgments and poor financial choices. Here are 10 heuristics that, if used inappropriately, can potentially destroy your wealth. Number 1. Availability heuristic. Relying on readily available information when making decisions can lead to biases, as important but less accessible information may be overlooked. This can result in poor investment choices or overlooking better financial opportunities. The availability heuristic can be because of media influence, recent market performance, familiar brands, personal experiences, and investor sentiment. These can influence investment decisions. By considering a wide range of information and not being overly influenced by readily available or easily memorable examples, investors can mitigate the ability heuristic and make more informed investment choices. Number 2. Mental accounting. This is the tendency to compartmentalize money into different categories, leading to suboptimal financial decisions. For example, individuals may be more willing to take risks with lottery money compared to their original investment. Another example: when individuals receive gift cards or vouchers, they may be more inclined to spend them quickly and less carefully than they would with their own money. Being aware of these tendencies can help individuals make more rational and holistic financial choices. Treat all money as same, as it has the same value in exchange. Number 3. Confirmation bias. Seeking out information that supports your existing beliefs while ignoring or dismissing contradictory evidence can hinder your ability to make informed financial decisions. Confirmation bias may prevent you from considering alternative investment strategies or evaluating potential risks accurately. If someone holds a positive view about a particular stock, they may seek information that supports their belief, such as positive news articles or analyst reports, while disregarding or downplaying negative information. This bias can prevent them from objectively evaluating the risks and potential drawbacks of the investment. Being aware of this bias is crucial for seeking diverse perspectives, critically evaluating evidence, and fostering a more objective and balanced understanding of the world. Number 4. Overconfidence bias. Overestimating your abilities and underestimating risks can lead to excessive risk-taking and poor investment decisions. For example, you may believe that you have superior knowledge or insight into the market, leading you to take on excessive risk or make speculative investments without conducting proper research or considering potential downsides. Recognizing and mitigating overconfidence bias requires humility, a willingness to seek feedback and input from others, and a realistic assessment of one's own limitations and capabilities. Number 5. Herd mentality. Following the crowd or basing decisions on what others are doing can lead to herd mentality, causing you to invest in assets or markets that may not align with your financial goals or risk tolerance. Herd mentality can manifest in the form of investment fads or hot investment opportunities. When a particular investment strategy, asset class, or cryptocurrency gains widespread attention and publicity, people may flock to it without fully understanding the risks or conducting proper due diligence. This can result in significant losses when the fad fades or the bubble bursts. Being aware of the tendency to conform to the crowd and critically evaluating choices based on individual analysis and independent thinking can help mitigate the negative impact of herd mentality. Number 6. Anchoring heuristic. Allowing initial information or reference points to heavily influence subsequent decisions can lead to suboptimal financial outcomes. Anchoring on a particular price or value may prevent you from accurately assessing market conditions or making rational investment decisions. Imagine you are considering investing in a stock. You come across an analyst report that provides a price target for the stock at $100 per share. Now, as you delve deeper into your research, you find additional information about the stock's financials, market conditions, and industry outlook. Based on your analysis, you estimate the stock's intrinsic value to be around $80 per share. However, because of the anchoring effect, you might unconsciously anchor your expectations to the initial price target of $100. As a result, you may perceive the stock as undervalued and potentially a good investment opportunity. To mitigate the anchoring bias in financial decision-making, it is important to critically evaluate the available information, conduct independent research, and consider multiple perspectives. Number 7. Recency bias. Giving more weight to recent events or experiences can lead to overreaction to short-term market fluctuations. Focusing excessively on recent performance without considering long-term trends can result in impulsive investment decisions and potential losses. For example, if the market has been consistently rising, individuals may be more inclined to buy stocks at elevated prices, fearing they will miss out on further gains. Conversely, after a market downturn, they may sell investments hastily, driven by the fear of further losses. To mitigate the impact of recency bias, it is important to take a balanced and comprehensive view by considering both recent and historical data, analyzing trends over longer time frames, and conducting thorough research. Number 8. Loss aversion. The tendency to strongly prefer avoiding losses over acquiring gains can lead to suboptimal investment choices. Being overly cautious and avoiding reasonable risks may limit your potential for wealth accumulation. Suppose you have invested $10,000 in a stock. After a few months, the stock price declines by 20%, resulting in a loss of $2,000. The remaining value of your investment is now $8,000. Due to loss aversion, you might experience the loss of $2,000 more intensely than you would have experienced an equivalent $2,000 gain. The negative emotional impact of the loss can lead to irrational decision-making and influence your subsequent actions of holding on to losing investment, risk aversion, reluctant to cut losses, and regret avoidance. By recognizing this bias, investors can try to objectively assess the risks and rewards of their investment decisions, diversify their portfolios, and make decisions based on sound analysis rather than emotional reactions to losses. Number 9. Sunk cost fallacy. Continuing to invest in a losing proposition because of past investments or emotional attachment can be detrimental to your wealth. Evaluating investment decisions based on current and future prospects rather than past costs is essential for making sound financial choices. Investors might hold on to declining stocks, even when the company's prospects worsen, in an attempt to recover the initial investment, instead of cutting their losses and reallocating their resources to more promising investments. Overcoming the sunk cost fallacy requires a shift in mindset and a focus on future potential rather than past investments. Number 10. Gambler's fallacy. The gambler's fallacy is the belief that past random events influence future outcomes, even when each event is statistically independent. Succumbing to the gambler's fallacy can result in misguided investment decisions based on patterns or streaks that are purely chance. Investors may believe that a stock is more likely to increase in value after a series of consecutive price declines. They might buy the stock based on the belief that it is due for a price increase, disregarding fundamental analysis or market conditions. Being aware of these behavioral tendencies and actively working to manage them, investors can make more informed and objective decisions, thereby improving their chances of achieving long-term financial success and getting financial freedom. Hope you enjoyed the video, and we wish you all the best. Thank you for watching the video and happy investing. Do not forget to like, share and subscribe to our channel so that we can make more videos on financial freedom through virtuous investing.